Look at this erratic sequence of vertical bars oscillating up and down. This chaotic motion represents how most retail traders view the market, as a series of isolated, unpredictable lower timeframe candle patterns, completely devoid of macro context. But watch as this scatter plot snaps into a rigidly organized matrix of nested geometric containers. This is the DRW True C liquidity matrix. It replaces that visual chaos with rigid structural order. Zooming in on a single lower timeframe green execution box makes it look like an independent event. However, as we pan out, you see it is entirely engulfed within a massive blue container. This hierarchy means a 5-minute setup is treated as a subset of a larger 30-minute window. We are looking for micro-executions that physically align with the boundaries of these higher timeframe institutional blocks. We are going to build this matrix from the ground up. We will start by mapping its spatial geometry, apply the gravitational weight of timeframes, and finish by filtering the executions using quantitative friction metrics. Transitioning from standard pattern recognition towards structural algorithmic math allows a trader to align their execution with actual institutional order flow. The foundational unit of this matrix is the higher timeframe order block. A 30-minute blue container appears. Inside, a 5-minute green execution box materializes, projecting a pulsing stop-loss cloud horizontally, an active mathematical defense zone. The critical internal mechanic is this dashed yellow line drawn through the vertical center, the 50% midline or mean threshold. Institutional algorithms do not accumulate at the extreme outer boundaries, which widens risk and guarantees poor entry pricing. They rebalance their inventory precisely at this 50% equilibrium. To test if a midline holds, a candle stabbing below the yellow line but retracting to lock above it is a liquidity sweep, confirming limit absorption. Conversely, if a full body permanently locks below the midline, it's a structural violation. The setup is dead. Executing at the midline allows for precise risk calibration. Placing a hard stop 2 buffer ticks behind the midline drastically cuts your point risk compared to chasing boundary stops at the absolute extreme. Your upward expansion targets from T1 to T4 are then projected outwardly from this 50. A 30-minute mean dictates macro swing directions. A 1-hour mean acts as an impenetrable concrete floor for all lower timeframes. This timeline separates market sessions. Orange lines span the overnight hours, while thick gold lines mark the regular trading hours daytime segments. Standard setups blend these together, erasing true institutional volume. We must isolate these historical gold midlines, representing locations where billion-dollar capital was defended. When historical memory reacts directly with live price action, it creates an algorithmic liquidity shelf. If a live 5-minute order block forms in perfectly overlapping alignment directly on top of a 2-day-old historical midline, a violent algorithmic defense is highly probable. By filtering out overnight noise and isolating true historical data, you stop reacting to invisible levels and begin anticipating the heaviest algorithmic support zones. How do we differentiate between a basic order block that provides a minor bounce and one that triggers an explosive trend? The True C signature requires 3 metrics spiking past critical mass: MACD expansion, relative volume over 40%, and heavy ATR displacement. Igniting at overhead supply forces a breaker block flip. The resistance ceiling is obliterated, instantly turning into structural support. To measure the ease of movement through these levels, we use the Kaufman efficiency ratio. It calculates directional displacement divided by total path traveled. Neon green indicates high efficiency, straight line velocity requiring immediate execution. Shifting to yellow signifies balanced rotation, rhythmic swings for standard midline entries. Dropping to neon crimson warns of low efficiency chop, heavy overlap and false breakouts, where market orders must halt to fade extremes. Structural geometry provides the precise location, but quantitative alignment and the efficiency ratio dictate the exact tactical approach, preventing traders from forcing trend strategies into choppy markets. Here is the final synthesis. The golden zone. Watch the 50% midline, pre-market extreme, and cash open slide horizontally and stack tightly. Zooming in reveals these overlapping liquidity sources compressed into a 2 to 4 tick bandwidth, creating a high-density zone. Executing off this zone requires strict adherence to protocol. Do not place blind limit orders into a plunging candle. Front-running the algorithm leaves you exposed. You must wait patiently for the 5-minute candle to wick deep into the golden zone. This deliberate motion hunts and sweeps early retail stops. Execution must solely occur the exact moment the candle snaps back and fully closes above the stacked cluster. Your risk is rigidly defined by placing a hard stop exactly 1 to 2 buffer ticks behind the absolute lowest edge of that golden zone box. By layering spatial equilibrium, timeframe gravity, volume surges, and efficiency ratios, a trader stops attempting to predict these random movements. Instead, you execute alongside institutional order block architecture.